Welcome back to the Lending Technology Think Tank. My name's Colin White from Credit Connect. For those of you who just joined us, I hope you enjoy this session. We're going to talk shortly about measuring affordability and the impact that is having on the lending sector at the moment, and credit sector as well. In this section, we are going to be talking around different affordability pressures on the industry. But before we do that, just want to point you to the controls for this session. So you've got a panel in front of you in terms of controls that you can use. So in the top left, you've got an I information button that's got information on this session. It also gives you information if you want to log in and if you haven't already registered for our next session, which begins after this one, 11:55, and that'll look at the regulatory pressures on lending. Also, another icon on the left, it's got information on all of our speakers. There's also a bit of information on our sponsor as well, who are Experian. So we'd like to thank them for sponsoring this particular session and the event overall as well. There's also an icon there. We've got a bit of information about, you can have a look at links, external links about Experian and future events. So welcome you to have a look at that. But the important part of that is the speech bubble. If you've got any questions throughout this session, then please put them, type them in, and we'll put them to our panel throughout. Be really good to get your thoughts on that. Saying that as well, socially, if you want to interact as well, we've got our hashtag LendTechTT on Twitter and LinkedIn if you want to get involved with that as well. But let's move forward, and I'll hand over to Chris Warburton from our strategy. He's going to be chairing this session, and he will introduce our panel and we'll get the discussion going. So Chris, over to you. Thank you.
Thanks, Colin. Welcome back, everyone. If it's the first session you've joined, just to introduce myself. So I'm Chris Warburton. I'm going to be the chair for the event today. My background's been in sort of like risk operations, so everything from underwriting through fraud and collections. We've got three sessions left. We've just had one just on credit risk and the cost of living. This one here, we're going to talk a little about measuring affordability, and then we're going to come on to talking about regulatory and some of the digital lending aspects as well. So, but without any delay, we're going to start with this session, which is really around measuring affordability. And we've got four really great panelists to run through this today. We've got Andrea Cox, who's the affordability director at Experian, and Experian are one of the leading credit reference agencies and analytics companies in the UK. We've got Nicola Matthias, who's the director of risk and compliance at Freedom Finance, and Freedom Finance are in the digital consumer lending space, and they really sort of help consumers sort of navigate borrowing as well. So they've got a couple of products there. We've got Carla Lourenco, who's the head of credit risk at Salary Finance. Salary Finance are loans and financial services products, and they work with employers to help people get loans. And last, and by no means least, we've got Sho Sugihara, who's the CEO at Pave and Fuse. And Pave and Fuse support lenders with AI-powered credit risk and financial tools. So the four of you, thank you very much for joining, and you're very much welcome. And I suppose, just want to reflect a little bit on the last session. In the last session, we talked quite a lot about affordability, and it's quite interesting because there was almost like these two kind of aspects, which we're seeing sort of like credit seeking behavior, I suppose, almost like among consumer lending firms, and the mortgage sector was seeing almost like a bit of a slowdown. So it felt like the affordability was quite sort of like spread, and it's probably different than we might have seen historically. And Andrea, I know it's kind of what you look at, and I know it's a little bit outside of this session, but it'd be good to see in terms of does that kind of trend match and come with some of the trends that you've been seeing, which is affordability seems to be or unaffordability seems to be in pockets rather than across the board, and probably by sector. Do you have a view on that? Or
yeah, I think so. Definitely, affordability is very different depending upon what type of lending you're doing, and I think ultimately what it comes down to is the proportionality. So of what you need to do for an affordability assessment, and then also what types of affordability checks are you doing, whether they're electronic or not, or whether they're helped by technology, and the depth of the affordability assessment differs across those different sectors as well. So as you would expect for mortgages, you would expect a much more granular, detailed check of someone's affordability because of the size of the loan and the term of the loan. versus the other end of the spectrum in buy now, pay later and retail, where it's a much lighter check because the term of the loan is shorter, there's no interest on those loans. And so therefore the risk of consumer detriment is deemed to be lower than for the sort of larger loans over longer periods of time.
And I suppose over the sort of like the last, say, 5 years, I mean, how much has that sort of technology changed? And Sho, maybe I'm going to come to you first on that, just in terms of, how much do you think technology has been driving the way we sort of like do the assessment of affordability, as because Andrea was just saying? I mean, how much has sort of technology been driving different ways of working around that?
Yeah, so I guess one of our products is a bills protection credit line, and we primarily targeted self-employed or, let's say, kind of sporadic earning types of consumers in the UK, because we saw quite a gap in the market in terms of companies specifically serving that sector. And a key hypothesis we had was the advent of transaction data, mainly via open banking, would be a useful way to credit assess these individuals. And so I think new forms of data for sure have taken a really helped us take a good step forward in terms of assessing, I would say, slightly more challenging people who might have more unconventional credit backgrounds. And so definitely new data sets combined with, I think, analytics methods have pushed this forward. I think we'll probably come on to this topic later, but I think increasingly these data sets are becoming important in a more and more volatile affordability environment.
Yeah, I mean, Carla, what's your view, I suppose, in terms of like things have changed? We've already just talked just a bit about open banking there, and I think you guys do stuff with open banking too.
No, we don't in the moment use on salary finance. We are thinking to use probably in the future, but I have several years of experience of open banking. So I think that open banking, it's still a new subject for some of the small lenders and also the old lenders, because it's not roll 100% in the market. But I still think that this is the big change: real-time data and very quick decisions around that.
Yeah. And I suppose you have different streams of information. I suppose if you're doing it from employers as well, which is almost like built in the product.
Yes. We are the lucky ones that, because we work with the employer, we already have part of the affordability verify, that is the income that we could, because we are a sour deduction loan. So we already have this part of the affordability process in a very good shape, validated by the employer. So probably this data, the open banking data, will help us to assess better the expenses that the customer have.
But in some ways, you've actually got this additional data actually built within your product design, which is a bit enabled within it, which enables you to do different types of lending.
Yes.
Yeah. And Nicola, what's your kind of view into like how technology's changed over the last 5 years, and what how are we making progress in terms of like better understanding affordability?
Well, at Freedom, we've recently upgraded our platform to have the open banking data at the initial eligibility check. So that allows customer to combine their open banking data with credit bureau data, which gives the whole picture right up front. So enabling affordability assessments at the initial decisioning stage. So taking out anything that's not available to the customer. So removing friction, improving customer outcomes right at the outset. It means that we've got not one size fits all approach, so we can use a mixture of the traditional credit decisioning and the bureau decisioning, but also include all the data that we're collecting through open banking as well. So it's giving customers that choice up front and removing the decisions that are not available to them right from the beginning.
And we always talk about, I suppose, this extra data. So often we talk about it in the sense of enabling more lending. I mean, it really sort of like, I suppose, it to a certain extent, it sort of allows us to fill in the gaps around, to enable lending where maybe we didn't have the information before. Do you think there's a sense though with the speed at which things have changed that maybe in some cases it should enabling less lending for some customers as well, or is it always seen as upside? I mean, Andrea, I'd be good to like get your kind of view on it in terms of like, being fully within the data, particularly within the bureau world, and because you must, I mean, there's a lot of interest around lending more. I mean, do you think the nuance is just whether that's always going to be the case? I think on the last session we heard around sort of like maybe even declines going up.
I think the important thing with affordability checks is that actually what it should do is ensure that the lending that you're doing is right. It's the right lending at the right time to the right person. And I think that, to be honest, Chris, you're going to have scenarios, you're going to have swap sets between the two, whether you're lending more and whether actually you're declining, but you're actually doing that for the right reasons and you're not causing any consumer detriment. I think that's the important focus that we should have on affordability, is are lenders doing the right thing by the consumer? And I think that's obviously where the FCA are coming with consumer duty and their affordability regulation already in Kong. It's to make sure that lenders aren't lending to people who can't afford it, but can lend to people who can afford it, and so therefore aren't declining them on the basis of affordability without truly understanding the consumer's full picture and ability to pay back any lending that they're offering.
And I suppose we're in this sort of like wealth of data. I mean, do you think we can ever have too much data? I mean, your answer is probably no, but it'd be good to get the views of the rest of the team. I mean, we're getting sort of almost like into, because there's a risk of analysis paralysis, isn't there, in terms of like just having too much, and you don't almost like don't know where to stop. I don't know where to start.
I think it's the right data sets. Sorry to interrupt,
but
it's getting the right data sets to assess affordability, to improve financial inclusion. So generating more accurate financial offers, which is, I think, linking back to the last question, it's getting the right offers for the right people and therefore delivering good customer outcomes, empowering the customers to use their data to their advantage.
Yeah, and how do we go about, so I suppose, selecting what the right kind of data is? We talk a lot about open banking. We talk a lot about the bureau. We talk about recency of data. I mean, how do we go about deciding what is the right data to go after? I mean, Sho, maybe take that one.
Yeah, for sure. I mean, the approach we take is test and learn, right? You won't know from the outset if a new data set is good or bad, or I'm sure you can hypothesize, but I don't think that's necessarily the best to rule out something purely based on that. I think the best way is to try it out. And certainly, I think in a startup, which is what we are, you kind of have the privilege of being able to do that quite quickly. And so we do take full advantage of that. I think, what is important though, I do think there's a bit of with data, it's you have to be quite careful that you're not optimizing for incremental improvements with time, because there are a certain amount of data sets that you can layer more and more on and kind of get lost in that process, because it is fun. But does it actually help the consumer? Does it improve outcomes? Sometimes not. So I think, rigorous testing and learning is the best approach here. But I would say in general, the more data, the better.
Yeah, I mean, and how do you keep the focus on outcomes? Sorry, Nicola, we're going to come back. So how do you keep the focus on outcomes through that analytical process? Or Carla, sorry.
Yeah, it's only to complement. It's because in the past we were talking about big data, but now I think that we need to talk about smart data, how to transform big data on real insights for the business to have a proper decision. If this makes sense.
And how do you link the smart data? I'm going to link it back to the question. How do you link the smart data back to outcomes? So how do you make sure the right data to then look at outcomes? I mean, how do you sort of keep our feet to the fire in terms of making sure we've got the right outcomes, as Andrea was saying?
It's still for me. So for me, I think that first of all, we need to understand if the outcome it's supporting the needs that the customer ask us, right? Because when we give outcome, we need first of all to understand it's a good outcome for the customer or no. And the data support us, and with the right MI in place also, we can see if we cover the needs, if in terms of affordability, if the loan, the decision was on the right and responsible, and make sure that the loan is affordable. So basically what happened is that we can understand with the right MI in place what is the right outcome or no, or if also we need to correct something in the future.
And I suppose, how automated do you think decisions can be? I suppose you talk about outcome and what the consumer wants, right? And we make an assumption that the consumer usually wants the loan. But I mean, there can be other outcomes now, and it's sort of broadening a little bit in terms of like financial objectives with consumer duty. I mean, how automated do you think we can make decisioning? There's been a move to 100% automation. Do you think we're going to move away from that a little bit? I mean, Nicola, maybe comment.
Yeah, I think it's a balance. So I think you need to have the balance of the human touch and also have that technology working in your favor. So I think the fact that open banking gives us those pre-qualification checks, especially when you're talking within Freedom's world. So having that right at the front when we're looking at what financial services are available to them. So we're allowing customers who've been excluded from the market through no fault of their own, maybe a thin file or people with non-typical employment. We can use that technology then to build a better picture about the customer and see what they actually can afford versus what the credit bureau is showing us.
Yeah. I mean, I suppose what's your comment? I suppose the interrelation between open banking and the credit bureau, Andrea. I mean, on the last one we talked about open banking is almost like supplementing to a certain extent. I suppose recency of data and being able to sort of add on top of the bureau. But we do live in this almost like monthly world to a certain extent, even in terms of the months of the year, in terms of like where we get paid and those kind of things. I mean, how do you sort of see the two of them sort of like complementing each other?
I think they complement each other really well because obviously with bureau data, it depends what you're looking at really. So, but for bureau data, it's obviously not as granular, but it does give some evidence of that you can't get from open banking. So particularly around what other loans and credit does a consumer have. So you need to understand that credit data from the bureau. From open banking as well, I think yes, you do get more recency of data, but you also have to look at trends in data. So just relying upon the latest month for any affordability assessment, I just don't think is reliable enough. So you have to look at trends over time as well. So even in open banking, though, the data is more up to date, as in, it's real time. You still have to look at probably at least the last 12 to 18 months to understand what the trend in someone's behaviour is, both from an income and an expenditure perspective, so that therefore you're getting back to this truth. What is somebody's true income and what is somebody's true expenditure? Because without having a look at those transactions over time, you can't truly understand whether the latest bit of information you're looking at, so from an income perspective, may be the result of the fact that it's been a bonus month, or the fact that when you talk about the gig economy, where they've had maybe a couple of extra weeks work than they would do previously. So trying to get to a good view of an individual's affordability is about looking at data over time to ensure that they can afford what lending you're offering them.
Yeah, and I suppose if you're looking over a shorter time period historically, probably the time period you can look forward is probably shortened to a certain extent as well.
Absolutely. I mean, future affordability is difficult to establish with existing data, whether that's from bureau or whether it's from open banking, because what you don't know are what events are going to happen that could impact somebody's affordability. We can't foresee those, and as lenders, you're not expected to foresee those. But you should, where you can, take into account anything that you can foresee. So it's a difficult equation, really, trying to establish sort of someone's future affordability through the term of the loan.
Yeah, I mean, and that was going to be sort of my next question, which was maybe Sho, I'll ask you a little bit about how should we start thinking about predicting future affordability? Obviously we can look at trends, as Andrew just talked about, but I mean there might be future shocks. I mean, is there data out there that might help us? And there's been a lot of approach around looking at cutoff scores, which might restrict affordability. But is there a way of how should we build that into our models?
Yeah, I think at least in our case, what we've been investing a lot of time in with the consumer duty in particular is trying to really get granular on customer kind of profiles, personas. And the way we do that is looking at transaction data, and we can flag things like specific traits of vulnerability that we might need to keep an eye on in advance as part of an affordability check. So you're kind of expanding the initial categorization of your customer base that way. And then I think I totally agree with Andrea that the sort of open banking is complementary to credit file data, but one of the great benefits that you can get from that initial open banking check is a continued view on the customer's evolving personal finances, right? And so, well, at least 90 days for now, maybe longer in the future. And by using those two data sets, I think you can create a picture of affordability that is ongoing. So you might not be able to predict the future. Sometimes you can through early behavior and signals in the data set, but at least you have a picture of the customer that evolves over time and that you can constantly look at. And so one of our kind of big beliefs is that affordability cannot just be a snapshot. It has to be an ongoing dialogue, kind of both with data and actual conversations with the customer. And that's the kind of direction we've been pushing our own product, but also client relations as well.
Yeah. I mean, do you think we'll get to the point where we almost like have monthly affordability calculations on people? I mean, and you know, almost like monthly underwriting, although underwriting tends to only go one way, which is lending more rather than lending less typically, unless you've got line sign decreases.
It is true. I would say like actually already many lenders do this, right? There's monthly checks of credit file data, which I know it's not quite affordability always, but sometimes it can be. I think the industry is going in this direction. I personally think that we have to. Like, to me, it's actually quite crazy that we give people 25-year mortgages and don't really check on how they're doing again. It doesn't make any sense. Now, of course, there are flip side privacy concerns and different ethical concerns that one has to have. Imagine the insurance industry saying they're going to monthly check your risk profile. People would go and, you know, it would be general uproar. I imagine the same is true of credit. So there are kind of, you know, ethics concerns around this. That said, I believe this is where the FCA is pushing, right? This is the consumer duty, really, what it's trying to do, at least in my opinion. And I think as an industry, or rather as a company, we are very supportive of this because it should lead to better outcomes for the consumer. And frankly, I think it's crazy we don't do it already. So,
do you think it's almost, but I suppose it's almost like if you do an affordability, you don't want to be sort of like penalized because you've had a big, let's say you had a big shock because you've had all your family coming over for the summer. I mean, does that affect your sort of like your future affordability? And I suppose is that, you know, how much the short-term type expenditure really reflect on long-term trends, as Andrew is kind of saying. We're sort of into this, like, we need to do everything now. We're in this like faster cycle, but actually there are these long-term trends around whether people actually have the behavior to pay back. I mean, is there not sort of a balance there? I mean, Carla or Nicola, I'm kind of interested in your view on that.
Yeah, I think from my perspective, it is that balance. It is using the information that we can get, which identifies those sharp changes in costs or affordability, the shocks, for want of a better expression, but then also having that longer term picture. And I agree with Sho there that we need to be giving the consumers support through the lifetime of their product by looking, is there something that would suit them better, looking at their expenditure, looking at the long-term picture with the customer. Can we move them from one product to another to suit their needs at this time? And I'm not saying that would be on a monthly basis, but you can build up that trend data, ensuring that you're always transparent with the customer as to what you're using it for, why you're using it, and making sure that you're not using data sets that perhaps are not useful in this way. But definitely the very fast pace collection of the data allows us to support the consumer better by having that, looking at when they do have shocks and looking what else is available to support them.
I mean, and Carl, I'm kind of interested in your kind of view, because you've got a slightly different view on things from a product point of view. I mean, you obviously have the affordability in terms of like expenditure, but you probably have really good real-time data around income. But that does bring into, so I suppose, potential shocks. If you're meddling across multiple companies, you know, there's potential for like, you know, business downturns, you know, those kind of things. I mean, which becomes, can you get forewarnings around things like shocks that could come through? Because you sort of like you're probably a little bit close to that those kind of aspects.
Yes. So again, because our loans it's given by the employer, we have that data with us. So on a monthly basis, the employer will give that data in advance. But again, sometimes we have the data only a previous month, as you understand. Yes, and with our data, we can understand, for example, if the employee goes on maternity leave, for example, if he had a reduction on the salary, if he went in a long sickness. So we have the availability to understand very quick what happened in terms of the income, if the customer had a shock there. In terms of the expenses, no, we are as a normal lender as the others, and we need to rely with open banking or what the customers declare or other source of data.
Does that pre-warning allow you to react quicker in terms of like putting things in place, maybe quicker than other lenders, because you have that earlier warning? Do you think?
I hope so. But yes, we have that availability internally to react quick, and also not make the customer eligible, for example, if he wants to have another loan with us. That is the benefit that we have in the moment.
Okay. I mean, Andrea, coming back to you, in terms of like talking about, I suppose, bureau and open banking, we talked quite a bit about that and explored that. I mean, how automated do you think loans can be? I mean, we've been moving towards this sort of like automation, recency of data, I suppose, like fast-paced kind of trying to automate things and having decisions made as fast as possible. Is that trend going to continue, particularly with things like I suppose accessibility and understanding what outcomes are, or do you think it's going to moderate a little bit, particularly I suppose with consumer duty coming down the road, or do you think it's still a theme that we're going to see? Fast decisions, automated decisions.
I think it's still a theme. We can't go through the rigor that is required, say, for a mortgage application and the really detailed INE for every single applicant, every single loan applicant in the UK. It would have quite an impact on lenders' ability to lend. I think what it will do I think what we need to do is segment risk better, both credit risk and credit risk is standard practice. It's been around for a lot longer than affordability risk. And I think from an affordability risk perspective, when you're looking at the creditworthiness assessment, I think that particularly as a result of recent economic changes, both as a part of the lockdowns and also the cost of living, that there's a focus on affordability and how that's changing. And I think there are going to be individuals in the UK with the right data set that you can say is easily affordable. But what we're going to have to do, I think, is where you can't define it as being easily affordable, then potentially in those cases where you would typically refer them and maybe do more detailed checks. So I think there will be a move, but it will be for those cases where affordability checks and the data currently available doesn't enable you to make that fast decision. And I agree with Sho as well in the fact that consumer duty and the new regulations that are coming in place in July puts a focus really upon continuously monitoring affordability. And what does that mean? Now, I don't think that necessarily means doing an income and expenditure check every month, because I don't think affordability is just about income and expenditure. I think it's about looking at wider things than that. And so you can monitor other sort of measures of financial health or financial difficulty. And you can do that across your customer base now. So you can tell if somebody is taking out more loans than they were previously. You can understand if their credit utilization's changed. Are they using their overdraft more? Are they using their credit cards differently? Are they paying their credit cards differently? Were they a payer in full before, but now they've started moving towards more, maybe in the worst situation, a minimum payer? And have they taken out more credit? Have they taken out more credit cards? Are they starting to go to payday loans? And all of that kind of information can build up over time a view of someone's financial resilience. and whether or not they're moving into financial difficulty. So measuring affordability isn't just about income and expenditure, and it's not just about shocks, income shocks or expenditure shock. It's about how is that individual coping with the day-to-day costs of living, and have they got sufficient income to meet their outgoings. And I think that there are measures that we have today that enable us to assess that.
Yeah, and I suppose how about you mentioned affordability risk there as well as sort of like do you think how much when we talk about affordability, particularly open banking, we're often in the detail around salary confirmation, or in the details around certain transactions that have come out. How much do you think in the future we're going to sort of simplify it much more, a bit like we did with credit risk, in terms of like credit risk scores, into much more like a wider suite of scores, rather than talking about almost like individual elements in terms of like do they have affordability in terms of disposable income or not, which is an absolute term rather than a score term?
I think, to be honest, it's more difficult, and affordability, and the reason I say it's more difficult is because the expenditure element of the affordability equation is really difficult to establish and understand at a modelled type level. So we know that obviously a lot of lenders are using ONS data at the moment. And models work really good as an average, but not at an individual. And so if we continue to use these averages without actually getting more granular or actual data where we can, you could be causing consumer detriment, because you're putting in an average to an individual just because of where they live. And it could be completely wrong. And so therefore you could be making the wrong affordability decision about that individual. So I think it's harder than credit risk, if I'm completely honest with you. Credit risk is a very simple, are they going to pay me? Are they not going to pay me? The outcome is easy to measure, right? Are they paying me, or are they not going to pay me? From an affordability perspective, what is a good affordability outcome? And as I mentioned earlier, there are a number of different measures. It's not a single measure. So for one person, it may be that they go and take out additional lending. For another, it might be just that they cut their costs. They turn down their heating bills. They don't go out as much. So everybody, how they spend as a consumer, I think is difficult to put into averages, if I'm completely honest.
Yeah. I suppose it's just interesting to like, how do you almost like systematize doing it on a monthly basis? I mean, is there a way of doing that? Because if you have a lot of complexity, then it requires resource to then look at that. I mean, Sho, you seem to be sort of in favor of doing it on a monthly basis. Do you think we can sort of simplify the process, the affordability process, and how would we go about doing that?
Yeah, I might not give you the answers people want to hear here, but I'll go anyway. I think that the first thing to note, I'm being a bit facetious when I say monthly real-time affordability, ongoing checks. Obviously, the circumstances of someone's affordability don't change that quickly. So it might be just a huge amount of money spent on AWS that isn't useful. So you got to be, it's going back to that point of like too much data. That might be an example of that. So that's one point. I think the second, though, I actually don't think this is going to get more simple. I would defeat the purpose, in my opinion. I again agree with Andrea here. I think one of the things that excites me most about the sort of advent of transaction data, open banking data, is the granularity you can create, right? Because affordability is one thing, income and expenditure. Let me try that again. I think what I want to say is, I don't think one should see open banking as just income and expenditure checks. It can be much bigger than that, because you can see things like, as mentioned earlier, has someone suffered a bereavement, or has someone recently become a parent? All these things that the FCA does want firms to like start considering, even not at an individual customer level, maybe at a higher level, but still, you can see these things. And I think you can build these things into, affordability indicators, but also different things like vulnerability indicators, which is, I think, the kind of third dimension that is coming out now in credit. We've got credit risk, affordability, now vulnerability. And my, or at least our contention, particularly at Fuse, which is our sort of AI analytics division, is that this is going to be much, much more important over the next few years, and an area that transaction data and other data sources can really augment and help lenders become much more outcomes focused for their customers. So I think, yeah, it's going to get even more granular.
Nicola, what's your kind of view?
No, I agree. I think there isn't going to be a one size fits all. I think we are going to have to get into the detail. I think we're not going to be able to use averages. I agree there with Andrea. We see a lot of the lenders that we work with who use ONS scores, and customers are telling us different things, and we're feeding that back on a regular basis. So I do think there has to be that, and I keep talking about balance, but there has to be that blend, if you like, of using the data we've got to build the pictures we need. And I agree, it's not going to get simpler. I think we are going to need better analysis completed to enable to use this data.
So we're all talking about extra complexity, which requires extra resource to manage the extra data, to do the thinking. You can even have inconsistencies in terms of data treatments between. I mean, so there's no standardization as well. I mean, how are we going to manage that extra complexity? I mean, how do we need to start thinking about that in terms of our organizations and like how we manage that, because it's obviously it's extra cost to the business model as well. I mean, is it just something we're just going to have to absorb? I mean, and or do you think there's moves to try and sort of standardize some of it, standardize the approaches at least anyway? I mean, Carla, I'll ask you a little bit around that in terms of like credit risk treatment, in terms of like, do you see this extra complexity coming through?
Yes, especially now with the consumer duty, right? Because as my colleagues was mentioned, we need to understand how to give a responsible lending decision, and to have that, our decision not sits only on the financial part, but needs also to sit on the need of the customer, and also on the vulnerability characteristics of the customer, and also on the part if is the loan affordable for the customer and cover the right needs. So now with the consumer duty, I think that all the lenders are aligning that approach. At the time of application, we need to understand who is the customer and what are the customer needs for us to support better with the right decision and the responsible decision.
So with the added complexity coming through, how much do you think technology is going to be an enabler to sort of help us manage that extra complexity? Nicola, maybe come back to you at Freedom.
Yeah, data analytics, we've just invested a whole heap of people and time and money into data analytics and looking at better ways that we can analyze the data we do have access to in order to manage that complexity. Of course, we're always going to have people. We give people the choice, especially as Carla says, with consumer duty. We need to ensure that we're helping customers meet their financial objectives, but also not causing harm by giving them going back to the initial conversation right at the beginning, by giving them more products that rather than the right product. So data analytics has become, the buzzword, if you like, the talking point continually at Freedom Finance. We're looking at what we can do better with the data we've got.
And I suppose the question is, like, how do we manage, I suppose, the investment in data, which we've seen a lot of investment in digital, versus then also saying customer-centric and potentially even sort of making sure we understand the customers and understanding customer outcomes as well. And that feels like a little bit of a tension that's sort of building, because investment in the data and the digital, investment in data scientists, data does take investment, doesn't it? Which can take away from elsewhere. I mean, so how do we make sure we stay customer centric and really understand what the customer's objectives are? Sho, maybe take that one in terms of like what your approach is.
Yeah, I think so I actually am not from a finance background originally. Well, I've been in the industry now 5-6 years, but prior to this, I was in healthcare of all things, so very different background. And one of the things that really baffled me when I kind of started learning about the credit industry is no offense to anyone, but like how much redundancy there is in processes. And what I mean by that is, let's take credit file data analytics, or let's take open banking transaction enrichment and analytics. Most of the lenders that we've spoken to are all doing the same data analytics. And when you think about that, you're kind of investing time and resource into part of the value chain that is quite basically commoditized. Shouldn't you be investing more time and resource in serving customers better? This is a real tension that I think personally I've kind of noticed. And maybe I'm completely wrong here, but like as an outsider, that's the most kind of intriguing thing that I found. So my point is, I think I do think a lot of technology can like help us build a better understanding of the customer, like by enriching transaction or credit file data to paint a really accurate picture of the consumer. Should firms be investing in that technology themselves? Personally, I don't think so. I think one should be investing in, ensuring good outcomes to the consumer through excellent customer support or ongoing care journeys or whatever it is. So my contention would be that that's where resources should go. And parts of the value chain that are going to get commoditized again, which I actually think is the analytics element, that shouldn't be. Personally, I wouldn't be putting all my money behind that if I were a pure lending business CEO. I don't think that's the best way to ultimately win the customer over. That's
I mean, Andrew, you've sort of been at the epicenter of a lot of credit data. Experian have been. I mean, do you see there's the other issues of standardization around how we start thinking about the data, how we start thinking about some of these forms of data, because it can become endless in terms of the amount of analysis you can do, and that sort of obviously ripples across each of the lenders potentially as well. Is there some sort of forms of standardization that we can sort of drive?
I don't know if it's about standardizing the data and developing new scores, which again, like I say, you're trying to average, you're trying to look at a group of people. I think it's about volume of data, so getting the right data, and that will mean more data, not less. So, but using it in the right way and automating that process. So I think through technology, it's about getting more data, but using that better, and using that through deeper analysis and through investment in analytics to get to a more individual view rather than an average.
Yeah, and I suppose how does this relate to? I mean, we're going to talk about consumer duty in the next session. But I mean, how does this conversation around affordability link to consumer duty? And good to get your view just on where you think the industry is on using that data at the moment.
I think there's two elements to consumer duty that we've spoken about on this call. The first one is, can you validate that the decision that you made was the right decision? Was it in the best interest of the consumer? And so you're effectively validating and verifying that you made the right decision, and that your credit policies, your affordability policies at the point of that decision were the right ones. And if they're not, by looking at data, how can you reassess that and improve that to make sure that you're always getting a better customer outcome? The second element is around vulnerability, as you say. So, and in here I'm talking about financial vulnerability, specifically around consumer duty. How are you identifying and acting quickly when you see that somebody's getting into financial stress? Are you continuously monitoring that, and are therefore you taking the right approach and the early steps to ensure that they don't get into more debt, or that they're are you offering the right solutions, the right type of forbearance solutions at the right time? I think that as an industry, the one thing that I think we're struggling with at the moment, if I'm completely honest, is what is a good affordability outcome? Because as I mentioned earlier, it's not quite as easy to measure as credit risk. It's not, are they paying me or not? What is a bad outcome for a consumer when you're looking at an affordability assessment? And I don't think there's a single measure. And I think there's multiple measures around financial difficulty, understanding what was a good or bad customer outcome. And it's really getting, I don't think there is a standardized view across the industry on that. And that's where the challenge lies.
Yeah, I mean, we don't have long to go, and that's for sure. I mean, Nicola, I know if you put your compliance hat on a minute, I know we were chatting earlier a little about good customer outcomes, but then there's also the evidencing element as well. I mean, I think you mentioned that to me as well, which is a big part of it, isn't it? So, and we talked a bit about, even on this call, around almost like I know you didn't say it, but a monthly affordability, but like, is that good sort of evidencing to really evidence that you are actually keeping on top of whether the people are getting into financial difficulty or not? I mean, what do you think the interplay and the linkages between that? Because it sounds like that's going to be a challenge in the future.
Yeah, definitely, I agree, and I think one of the strengths is going to be, or something that we're going to need to do as an industry, is talk more from in what do they call them? Distributors and manufacturers are going to have to speak to each other a lot more and share a lot more data back and forth. And I think Consumer Duty requires a firm to match the right product to the right customer at the right time, ensuring that the price and value suits that customer's needs. And I think open banking is critical to doing that. The data that we see is critical to doing that. But I also think that declining a customer is no longer always a good customer outcome, just as giving a product to a customer is no longer the good customer outcome. Yeah. And I think that's something that we need to agree as an industry. And I don't think we'll ever agree on what that customer outcome should be, but it's no longer good enough just to decline. And lenders with prime products need to ensure that they're supporting customers either through giving them availability to other products that may better suit their objectives, or even by providing better education to help them improve their financial situation. And we're going right back to that, maybe not monthly affordability checks, but ongoing reviews of customers' data and customers' accounts to see how we can better provide education. And that's something that we've been doing at Freedom, is looking at other ways. So when someone comes through wanting a loan, is maybe a loan's not the right outcome, and we need to give them some debt counselling and help them to improve their circumstances.
And it probably goes back to some of what Sho you were saying around almost like, how do you sort of build that relationship with customers? So you know, as much as you possibly can, right? So I was just writing down around, because we got regulation coming up next, is the next session. So I'm just writing down to make sure I ask the question around decline. So I think that's a good point. So just to wrap up, I suppose, you know, so where do you sort of like see us as affordability checking going from where we are today? And we talked a lot about affordability, about open banking, talked a lot about transactional detail, talked a little bit about scoring potentially. But I mean, what's new on the horizon? I mean, and where do you think the industry kind of goes from here really in the next sort of 3 to 5 years? I mean, Carla, do you want to go first? I mean, what do you think? What are the challenges, but also some of the optimistic kind of points you see sort of coming down the pipe at us?
Yeah, so for us, the main challenge, I think, that is what Nicola was mentioned about, the complexity of things that we need to look on. And I think that how we need to start thinking is that we need the data for sure, because each customer is different, and we need to understand who is our customer, and for sure it's the data that will show us that. So I think that the future for us, probably it's understanding better the data that we have internally, and how we capture the data, and how the data can help us to give a better outcome to the customer, and who is our customer. So basically, I think that as a market lender, we need to invest a little more on understanding the data and how that help us and inform us in future decisions, and understand how we can provide a better outcome to the customer. So invest a little more on the data. I think that now it's and transform that as a smart data. I think that is our future and the challenge for future.
Sho, what's your view the next sort of 3 to 5 years? Where do you think the market's going?
I think you're going to be able to predict one of my answers, but one of them is real time for sure. I'm a big fan of that, as you know. The other I would say is granularity. I really think there's such an opportunity to say this person has self-employed income, or kind of less stable earnings patterns or whatnot, looking at transaction data and other data sources. And I believe that's where affordability is going. So there's going to be kind of a quality of income element, which I'm kind of terming as granularity. And then I think the last thing that this conversation has made me think of, and thanks Andrea for kind of putting it this way, but like the outcomes element is a super interesting question. And kind of the positive answer here, if we're kind of holding ourselves accountable to better consumer outcomes, maybe the outcome for affordability is the customer's affordability should improve over time as a result of the product that you've given them, because they've become wealthier. Something like that is where I would like the industry to go. That would be really exciting, wouldn't it? Just actually making an impact. So yeah, that's the third element that I, thanks to today, have will keep in mind.
Nick, I'm going to come to you. I'll come to you last, Andrea. Nicola, what's your kind of view around where we go from here?
I still think open banking is not commonplace. And I think we need to get to a point where it becomes commonplace. And although more lenders are now using open banking, we're still seeing them using it to say no to customers rather than to say yes to customers. So I would like to see that in the next 5 years, we move to a point where we're smarter at processing that data. We're looking at the couple who've been high rental environment for a long time with very small file, thin file, because they've been renting on high rates for a long time. We're using that balance of the data available from the Bureau and the data available from open banking to enable those to move into the housing market if that's what they want to do, because we can swap out, the lenders can swap out that rental income for mortgage. And that's the way I'd like to see it going, is using it in a positive way to assist the customers, to support the customers, but also to enable them to meet their financial objectives, whatever they may be. I think we're a way to go there yet.
And Andrea, what was your kind of view? I think that what Sho was saying, it's almost like, how do you look at, particularly comment around the improving affordability over longer term. I think that's quite an interesting kind of concept. I'd like to see that in a score, but we ran on that. That'd be quite an interesting score to have. But where do you think we go from here?
For me, I think, like I say, up to now, affordability has always been what disposable income does somebody have, and looking at income and expenditure to get to that view. I think I would like affordability to become more than that. So very similar to Nicola's point, can we use affordability positively? I feel that at the moment it's seen as a regulatory requirement, and so that's why it's happened, and that's why lenders are doing it, because they have to. And I think that hopefully the introduction of consumer duty and putting the consumer first, and understanding what these SWOT sets are and how affordability can be used positively, I think that's how we change the behaviours of lenders and also do the right thing by the consumers. So that's where I'm hoping, like Nicola, that affordability can be used as a positive.
Yeah. Well, thank you everyone to the panel. I appreciate your insight. I mean, it's been an ongoing topic for such a long time, hasn't it? In terms of affordability, it does feel like it's evolving, and we've been through sort of like quite a wave of like huge amounts of detail. I think it sounds like we're starting to get on top of it, although maybe it sounds like maybe there's also a little bit further to go as well. So thanks everyone for joining, and I'm not sure if Colin's able to join us to finish the call. So thanks everyone.
Thanks, Chris. I don't know if you can see me actually, but yeah.
No, we can't. Yeah, we can't.
Yeah. So yeah, no, thank you everybody. Really interesting. I think with what we're talking about today, we almost lead into the next thing all the time in terms of where we're going. But we're going to be looking at measuring affordability in our next session at 11:55. So for people who want to join us for that, that'd be awesome. But there was some really great, interesting points made across there, and it's interesting to see where it will all head alongside with what's going on with the economy as well. So that's really good. Thank you. So big thanks, obviously, to Andrea, Nicola, Sho, and Carla for their insight there. Really good. And of course, Chris for chairing the session. These sessions are obviously recorded, so if you missed anything, then we will be publishing them at a later date via YouTube, or in the short term, it will be on a link which we'll put on the Credit Connect website next week as part of the news as well. But then round up by saying thanks to everybody who tuned in, and obviously thanks to Chris Warburton as well for chairing. And we hope to see you all again soon at a future session or later today. So thanks a lot, everybody. Cheers. Bye-bye.
Thanks.
Thanks, everyone. Cheers. Bye. Bye.